Navigating tax brackets, or what we call tax rates, is so incredibly important, especially when it comes to lowering your tax bill and tax planning. That is why in this video, I am going to be going over tax brackets with you to make sure that you understand how to maximize the utilization of tax brackets. But before we jump in, I'm gonna need you to like, comment, and subscribe so you don't miss out on any of this wealth building information. Now, let's get after it. Tax brackets really refer to income tax rates. They are broken down by brackets, meaning that you may be going from the 10% bracket all the way up to the 37% bracket. And each different filing status, single, married filing jointly, married filing separately, has a different tax bracket depending on how much income you make. So one thing I want to make sure I go over with you guys is the different tax brackets. And no, I do not have them memorized, so don't even comment about that. For example, if you are a single individual, you're going to start out in the 10% tax bracket. And the 10% tax bracket is going to take you all the way up to $11,600. That means that any income within that range gets taxed at 10%. You're going to then jump to the 12% tax bracket. You're going to go to $11,601, all the way up to $47,000 is going to get taxed at 12%. And the brackets go 22%, 24, 32, 35, all the way up to 37%. Realizing that every single type of filing status, for example, married filing joint, you're going to get taxed at 12% up to $47,000. But for example, you can go all the way up to $365,000 per year and be taxed at the 35% tax bracket. So understanding tax brackets is mission critical, especially when you want to keep your tax bill low. You want to know when you're going to cross over into that next tax bracket, that next category, and realize only the incremental difference is going to get taxed in that next category. That's important to understand. So when a person says that their tax rate is 37%, really probably the last 10,000 or 20,000 is being taxed at 37%. So now that you know tax brackets, you can plan to lower your tax bill much easier. When you understand tax brackets, you can utilize strategies to lower your tax bill. Allow me to give you an example. If you are single, as an example, and you're being taxed in a 12% tax rate, and you've made up to say $47,000 per year, and you know you're going to cross over because maybe you're going to cross over to $50,000 or $55,000. By you contributing to a retirement plan, contributing to a 401k plan, that allows you to take that additional income, defer it, not be taxed on it, and drop yourself back down in a lower tax bracket. That's what's so important about tax brackets. Figure out those things that you can do to lower your taxable income to get you down into a lower tax bracket, whether it's going to be a 401k, whether it's going to be stock loss, whether it's going to be opening up a business that takes a loss to drop your income down. Either way, understanding where you are in your bracket is mission critical. Additional strategies you can use to lower your overall taxable income and to come into a lower tax bracket is like a health savings account. You may wonder why a health savings account is so important. Aside from the fact that you can set aside taxable money and make it tax deferred to pay for medical expenses that seem to be outlandish these days, that deferral lowers your taxable income, putting you again in a lower tax bracket. That is also why people contribute to charitable contributions, not just because it's philanthropic, it's a nice thing to do, but giving money to charity puts you in a lower tax bracket. So why should I allow that additional money to get taxed at a higher rate when I can do a donation, drop my income to a lower tax bracket, and avoid the taxation and feel good about what it is that I'm doing. It's the same with tax loss harvesting. This is where if you have investments in stock, for example, you're getting down to the end of the year and your portfolio is negative, you may want to go ahead and sell that stock, create a taxable event on paper so that you can use that write-off against your taxable income, again, lowering you down into a lower tax bracket, a lower effective tax rate, so you can pay less in income taxes. Understanding strategies is mission critical. Timing your income and expenses is also important. Allow me to give an example. We always want to have low taxable income depending on where we are financially and what we're trying to achieve. So for example, if I'm going to get a bonus and I know that bonus is going to put me over into another tax bracket, I might say to my employer, can you pay me that bonus in January? Because I don't want that income to bump me up to a higher bracket. Additionally, if I own a business and I know customers are going to be paying me, I may choose to invoice my customers at the beginning of the year versus in December because I don't want my income to increase and again, put me in a higher tax bracket. Well, think about that when it comes to your expenses. You always want to defer income, but accelerate expenses. If I can get my expenses written off in the same taxable year, I can drop myself down into a lower tax bracket. So the key is only for tax purposes, my friends, is to defer income and accelerate expenses. Now, let's never get it twisted. If somebody owes you money and you know they're not going to be good for it in a couple of weeks or 30 days, you get your money today and we'll worry about the taxes later on. But just understanding how you can defer income and expense out your expenses to lower tax is key for you. Once you have understood and really mastered tax brackets, tax rates, marginal tax rates, it's also important that now that you've reached this point in the video, that I give you a bonus tip, and that is to use tax credits. Once I've established what my tax liability is going to be, I have maxed out my deductions, I deferred my income, and I've done all the other strategies to reduce my tax bill. Now it's time to pull out the big guns. And by that, I mean tax credits. Tax credits are dollar for dollar. That means that if I owe IRS $5,000, $10,000, and I get a tax credit that is $2,000, that $2,000 is gonna wipe out $2,000 of the $10,000 that I owe. It's dollar for dollar. So tax credits are extremely valuable, and they're more valuable than deductions. That's why it's so important to understand the child tax credit. It's important to understand when you phase out of credits, just like you go into a different tax bracket, when your income goes up, you may phase out of being able to take a particular credit. If someone is gonna pay me an extra $1,000 and I'm gonna miss out on a $3,000 credit, I'm gonna tell them, keep your $1,000 only this year, give it to me next year, because I wanna take advantage of that credit. So understanding how this works is important, and really understanding tax brackets, how to look at your income from a tax bracket perspective, understanding filing statuses, single, head of household, married filing joint, married filing separately, understanding your tax brackets, understanding the strategies to reduce your tax bill, charitable contributions, HSA, a 401k. These things are important, but most importantly, accelerating deductions and deferring income. That's important as well. And at the end of the day, when all else fails, reach for the tax credits. That is why now that you know better, you gotta do better. I want you to reach for that like button. I want you to comment and subscribe, because you can't afford to miss out on this wealth building information. Now I want you to go get after it.